2013 was a tough year for the mining industry. It's no surprise given the labour unrest, the cost pressures, global economic weakness, that the mining industry margins really suffered. The profitability is down. On the revenue line, the reality is that revenue was flat on last year, and on the platinum side, revenue actually decreased. Earnings before interest, tax and depreciation and impairment down by 24%, and not even sufficient to cover the sustainable capital investment that's required by the industry. When we look at value added, the value added declined significantly by about 142 billion rand. Yet if we look at the distribution of that value, then shareholders' share increased to 36%, the reinvestment in the industry remained at 37%, the government share remained at 21%, and the reality is that other expenditures had to be funded by about 20% of retained reserves. This is not a sustainable position. The reality is that the mining industry will have to focus on cost management, that revenues will have to increase, and without that, our country will have a problem. If we look at commodities, platinum is clearly in a difficult position at the moment. EBITDA margin of only 13% is well below what's required, actually a net loss-making position. Most platinum mining companies are having loss-making operations at the current low price environment. Our prognosis for the future of the platinum industry is that fundamentals should mean that the price should go up. South Africa supplies 70% of the mined supply of platinum, and with expected demand continuing to grow in the east, there has to be an increase in the price. The alternative to that is closure of mines locally, which will reduce supply and again will factor in the increase in the price. Investors have shown us by investing in EFTs that they've got more faith in the metal itself than actually investing in the companies. Again, not a sustainable situation.